Our next panel is on, as you can see behind me, climate finance and tax justice. Our moderator is Franziska from the Tax Justice Network, who I'm honored to ask to join us on the stage. Can you please all join me in welcoming Franziska to the stage? Can I also please ask the panel speakers to join on the stage as well?
Okay, good morning. I hope you can hear me okay. Apologies for any coughing that might happen. I have some tea here. But yes, it's not great timing for this voice, but I think we'll make it work. So welcome to the first event of today. The panel is called Climate Finance and Tax Justice, Emissions Inequalities, Carbon Taxation and Global Solutions. I'm Franziska. I'm a senior researcher and advocate on climate and inequalities at the Tax Justice Network, and I'll be moderating. So Gabrielle mentioned the big number in his opening keynote yesterday. The size of the climate finance gap is at least $500 billion per year. And this is what's needed for developing countries alone to make up for the costs associated with loss and damage and adaptation and mitigation measures to deal with the fallout from the climate crisis. We have heard that taxing extreme wealth could effectively fill quite a bit of this gap. And we at the Tax Justice Network back in December at COP28 also pointed out that this is about the same order of magnitude than the scale of global tax abuse as per our State of Tax Justice report. So we are grappling with these numbers. The details will vary depending on what you include in the estimates, because clearly there is so many expensive structural transformations that are necessary to limit global warming to 1.5 degrees. But the Paris Agreement never really set out, well, it set out emissions target, but it never really set out the specifics and the role of fiscal policy to deal with the implementation of those changes and how to achieve them. But there is increasingly a consensus emerging that at least part of the missing climate finance gap should be sourced through tax. We've heard it all day yesterday, directly and indirectly. And this is just through the revenue function of tax. But if we zoom out a little bit more, both the climate and the tax justice movement, I think, are really realizing just how aligned they are beyond revenue. They're both movements that want to redress discriminatory practices and colonial legacies that are being upheld by a minority of countries and of communities of people at the expense of everyone else. And we want a different, more inclusive system of governance to negotiate those terms. So we know that polluters have to pay for current and for past emissions. And while most people in this room will be, I hope, familiar with polluter pays principle, in practice, I did want to point out that inside the climate justice movement, we often refer to quite different units of analysis when we say polluters. We do mean individuals a lot of the time. We also talk about countries and corporations. They're all polluters and they all have to pay in different ways. And this diversity is reflected in the 4 really interesting papers that we'll be listening to now that look at different levels of taxation for climate justice, from the more micro to the more macro, covering different geographies and political realities. So let me introduce you to the speakers. First, we have Laure. Gnassou, she's an independent research economist. Secondly, we'll have Gabrielle du Marais. She's a researcher at Panthéon Assas University. Thirdly, we'll have a remote speaker, Yannic Rehm. He's a PhD student at the Paris School of Economics in Lucas's team. And fourth, we have Matti Kohonen, who is the director of the Financial Transparency Coalition. So I'd like to hand over to Laure. Laure, your paper is speaking to a few really important aspects. Firstly, the fact that carbon pricing is a very popular fiscal policy tool that won't go anywhere anytime soon, in which can, at least in theory, be a tool for both repricing carbon as a bad or an ill, but also a tool to collect revenue and expand the tax base. So please, over to you.
Hello, everyone. I would like to thank the organizer for inviting me to attend this conference and for giving me the opportunity to discuss emerging kaleidoscope of carbon pricing in Africa. I will focus on sub-Saharan Africa. This part of the continent is characterized by political instability and insecurity. When you look at the real GDP growth rate, the IMF considers that for this year, the sub-Saharan Africa will reach 4%, but African countries are confronted with a debt crisis. Over 80% of African economies are commodity dependent. Leveraging natural capital is critical to continue their economic diversification. So they are faced two competing development priorities. They have to embark on a green industrialization pathway while becoming suppliers of nature-based carbon credit. And why? Well, sub-Saharan Africa hold vast nature-based solution in terms of forests, peatlands, mangrove, and I can refer to the Mobile woodsland or the Congo Basin, but I would say that African countries are net carbon absorbers, but they have to increase their resilience to the impact of climate change. This includes addressing deforestation and forest degradation by setting up the UN REDD Plus processes. And by doing so, they will get access to climate finance, notably through a voluntary carbon market. So few data from 2016 to 2021, carbon credit issued from sub-Saharan Africa represented 21% of the total credit, total traded credit on average, and definitely the forestry sector is the dominant sector when it comes to the issuance of carbon credit. But navigating the carbon credit, I would say, navigating the VCM landscape has been a challenge for African countries because there is a need to for a greater market integrity and transparency. Another very important issue is that there is a rising demand for high quality nature-based carbon credit, and private sector developers and developed countries rely on the implementation of the Article 6.2 of Paris Agreement. This will allow them to generate carbon credit through the issuance, through the ITMOs. And by doing so, they will be able to reduce their emission. And last year, very interesting, Blue Carbon, Emirati private developers, has held a vast portfolio of carbon offset deal across Africa. And a carbon credit curve can arise out of this. What does I mean by saying that? Is that issuance, excessive issuance of ITMOs can reduce ability of African countries to reach their own emission target, NDCs. Also, there is a problem when it comes to the rights and livelihood of local stakeholders, including indigenous people. For them, their right could be at risk. And also the fact there is a unfair revenue sharing agreements, and that can limit the ability for African countries to access to climate finance. So Franziska said it about carbon pricing. There is a momentum about carbon credit in this world because it has a potential to achieve climate and a fiscal objective. When it comes to a fiscal objective, obviously this is a possibility to raise public revenues, to expand the fiscal space for critical investment in public goods. But this is tailored, when I said putting a price on carbon credit, or putting a price on carbon emission, this is tailored to the African context. So there is a dual scheme going on in Africa. In sub-Saharan Africa, South Africa is known for having a carbon tax act set up in 2019, and other African countries are going in this direction. Senegal, Côte d'Ivoire, Botswana, they intend to put in place carbon taxes. Nigeria and Gabon are expecting also to put in place national ETS. But funny enough, or not funny, I think all of them might be pushed to put in place carbon taxation under the pressure of the CBAM. Now the second carbon pricing. Who would think that this would be possible? Second carbon pricing consists in valuing carbon sequestration services of forest and natural ecosystem. And that is something very interesting. I will refer to this map, quite busy map, right? But interesting one, because it shows how African countries are ready to embark in this, the need to generate carbon finance. And so in this map, you could see countries busy putting in place a legal framework, and others who already have a legal framework. It's very new, brand new. But while forest-rich countries are ready to follow their own path, they have to make sure that they prevent carbon credit curves. And what does I mean by saying that? Is about a revenue sharing agreement, and it's also about the price of nature-based carbon credit. So Zimbabwe was the first country to focus on having a more equitable revenue sharing agreement. The state will take 30%, but not enough, we can say. But the private sector developers, they will receive 70%, and out of that, 25% will be allocated to local communities. The second country who advocate for a fair carbon price is actually the DR Congo, representing 60% of the Congo Basin for people, which is very important and interesting. And so the President Tshisekedi was the one to say $5 per ton is not enough. So he asked for 100, and study was done by Dalberg and UNECA, and assuming that the fair price of nature-based carbon credit could be about $50 per ton, this means that African countries could generate $15 billion per year in terms of carbon finance, which is very significant. Another issue, DR Congo is a great country, but and big country, but the problem is the following. What is the bargaining power of DR Congo? That's why DR Congo decided 2 years ago to join Brazil and Indonesia to form the Rainforest Coalition. And this coalition is very interesting because this gathered potentially the world's largest suppliers of nature-based carbon credit. Other African countries, Asian countries, South American countries, forest-rich countries can join this coalition. Concerning development challenge of African countries and forest-rich countries, I would say I have two final thoughts. First, I talked at the beginning saying Africa is confronted with political instability and insecurity, and for sure, there is a need to restore state authority. Without peace, no development, And for forest forest-rich country, it's very important because that might also contribute to reach sustainable management of the forestry sector. The other thing is African country has to build resilience to climate change, right? So they need to mobilize carbon finance. And so they need also to invest in capacity building, and development partners, and notably the UN, can play a role in helping to strengthen the forest sector governance by expanding the illicit financial flows program to the forestry sector, at least. The development partners can also assist countries who take the first step in implementing a legal and institutional environment, I would say, framework. And the final aspect, and I think the most important, about population, safeguarding, preserving the rights of small stakeholders, local communities, indigenous people, and smallholder farmers is also a prerequisite. I want to thank you for your attention. Welcome any question you may have. Thank you.
Thank you, Laure. Okay, next we have Gabrielle. Gabrielle, your paper does something I really liked, which is to not just provide even more data on just how popular progressive taxation measures really are. You also challenge the reader to think about what we actually mean by individual carbon footprint and whether this should be capped. And this concept of carbon footprint is changing a lot beyond the consumption side or what people do in their day-to-day. So over to you, Gabrielle.
Okay, so my paper is, its title is Ready for a Progressive Carbon Tax, Footprint Definition, Support, and Ethical Motives. So I'll start first with what I will call the definition of a progressive carbon tax. So that is when the marginal carbon tax rate increases either with income or carbon footprint. So the first example is the linear carbon tax, where you have, for instance, in terms of gasoline, you always have the same marginal tax rate. So for instance, 3 cents per liters. And you can also have a progressive redistribution, that is redistributing the tax revenues to the poorest. And you can have different types of progressive carbon taxes. So either, for instance, if you choose a carbon tax basis that is flights, the more you consume, the higher the marginal tax rate will be. So for instance, it will go from 3 cents to 5 cents for those who fly the most. And you can also have a carbon tax where the marginal carbon tax rate increases with income. So for instance, it could be interesting for gas, carbon tax levied on gas. That is, the higher your income is, the higher you will pay taxes on gas consumption. So that's the third case. So the motivation is that levying carbon taxes is linearly is quite unpopular. So there are several hints. So it's shown by surveys. So for instance, in 2019, there was a Europe-wide survey that showed that only 33% of Europeans were supporting increasing a linear tax on fossil fuels. This has also been shown by demonstrations like the Yellow Vests or the Don't Pay UK energy movement. And it has also been shown by some pushback in implementing higher carbon taxes, like in France or in Germany. So I will show the results that use a representative survey of about 1,000 French adults. And the paper's two main findings are that first, there is a higher support for progressive carbon taxes and individual carbon caps, that is caps that you cannot go over. And that there is a higher support compared to linear carbon taxes with progressive redistribution, that is to those most affected by the carbon tax. In general, those with the lowest income. And the second thing, this paper tries to hint that this finding rests on what I call ecologarian preferences, because it's shorter than like aversion to intratemporal footprint inequality. So the idea is that in taxation theory, we rest a lot on utilitarian social welfare function, and ecologarian, compared to strictly utilitarian social welfare function, is the idea that people don't only care about the distribution of utility, that would be approximated by the distribution of income and the amount of total emissions, but the people don't like having a high carbon footprint inequality, all else equal. And so this paper tried to hint that these ecologarian preferences are going to grow, and that they increase the case for progressive carbon tax. So I first tested in different ways the support for progressive carbon taxes on tax bases that could be applicable now. So that is on fuels, on gas, and on flights. So for each tax basis, I found that, for instance, fuels is the blue panel. I could show that, linear carbon taxes with progressive redistribution were not very popular, except for flights, which is the purple panel. And that for each tax basis, there was a higher support for progressive carbon taxes with uniform redistribution, that is redistributing to everyone equally, than for this linear carbon tax with progressive redistribution. And so that is, and this is particularly the case for progressive carbon taxes along the income distribution. But these tax bases are not very good, because if you take fuels, on average, it represents only 21% of the carbon footprint of a French individual, which is not so much. So you could say maybe people are in favor of progressive carbon taxes, but they think that these tax bases are arbitrary because they represent a very small portion of consumption and carbon footprint. And maybe because we're talking about future tax instruments, we could test the support with a carbon tax that would take into account a wider portion of an individual's footprint. And I think that there are currently some instruments that are developed. In France, you have different companies that try to estimate a person's footprint, taking into, for instance, banking data. And so maybe the age of having a quite precise and complete carbon footprint is not too far away. So that's why I wanted to ask what should be the carbon footprint and how should it be measured to maximize future progressive carbon tax acceptability. So for that, I asked people what should they take into account in a carbon footprint. So should they only take into account carbon footprint associated with consumption, or also the footprint associated with financial or even labor revenues? Because there has been a very recent study that estimated the carbon footprint distribution associated with financial and labor revenues. So, and I find that a majority of people want to take into account, at least partially or totally, emissions associated with financial revenues, and that more people are in favor of taking into account emissions associated with labor revenues than not taking them into account, even though more of them want to take that into account partially. So then I ask people if we were taking into account if we were taking this carbon footprint, would you support having a progressive carbon tax? And I compare that with what I call carbon VAT, which would take into account, which would be a carbon tax that would be levying a carbon tax on all fossil fuels in a similar way, which we don't have right now. And I show that here again, the support for a progressive carbon tax is higher than for linear carbon tax with progressive redistribution. And so I won't have time, but it's linked. I show that it's linked with ecological preferences. So I test that. One way of testing it, I tested in several ways, and I linked that with a model showing that it would influence the support for progressive carbon taxes. So there I asked people, we have this inequality of carbon footprint. Would you be in favor of having policies that wouldn't change the income distribution? It wouldn't change the total amount of greenhouse gas emissions, but it would change the distribution of footprint. And a majority is in favor of such policies. And then, so I give this information with these data on carbon footprint inequality, and I show that it increased the support for progressive carbon taxes, and that this is especially the case for future progressive carbon taxes with a wider footprint definition. And I think that this finding hints that support for progressive carbon taxes will grow, because I think we have hints that people are more and more averse to intratemporal carbon footprint inequality. So, for instance, the Elon Jet movement and the French equivalent of like following billionaires' jets to kind of shame people's very high carbon footprint, I think is growing. So I think this may be an ethical motive that we can build on to have progressive carbon taxes and environmental policies. And as a conclusion, so at the turn of the 20th century, it was a combination of acceptability, theoretical arguments, and newly administrative data that led to switching to income taxes and abandoning things like window taxes or less efficient tools. And I think that right now we have also this combination of the industry working to have individual carbon footprint accounting and some arguments in the economic literature as well as acceptability. So maybe progressive carbon taxes could be a next step in taxation history. Thank you very much.
Thank you so much. Thank you, Gabrielle. Okay, for real now, Yannic, I hope you're up there. A few months ago, Oxfam released new numbers on climate inequality and the outsized contribution of the richest to global emissions, especially the super rich, in what they call the Great Carbon Divide. They say that the super rich are key to the climate story in multiple ways, including through the outsized amounts of carbon they emit in their daily lives from their consumption, and through their investments and shareholdings in heavily polluting industries and their vested financial interest. So your team is really at the forefront of generating some of the most interesting data on emissions linked to capital and wealth. And you're prompting us to think about things like emissions intensity, among other things. So I hope this works. Yannic, you can start.
Thanks a lot, Franziska. I hope people can hear me well in the room. And just to say that the previous presentation was very much related to what I will be presenting, and it's very interesting to learn that you have already asked people what they think about expanding the understanding of what actually is should be part of the carbon footprint of people. So the paper that I will be presenting, it's more on on the measurement side, so to look at the distribution of individual carbon footprints, but with the idea to not only take into account the emissions linked to private consumption, but also linked to the assets and wealth owned by individuals, and to see how this changes our understanding of emission inequality. And then towards the end, I will have one slide where I show what this could also mean for environmental policies or tax policies, and in which new direction it could lead. Now I have to see, yes. So this is just to say, because the time is limited, if you, after the presentation, would like to get more details about the paper, the working paper is available online, so you will be able to find it and find all of the details also about the precise methodology we use and so forth. So again, to motivate a bit, if you have been following the debates about inequality in emissions and inequality in emission in individual footprints, you know that the dominant strategy to define these footprints has been to look at private consumption. And usually what studies have been doing is they start with a household expenditure survey. They look at what are the items that people spend their money on, and then they calculate some kind of emission intensity factor and construct the distribution of emissions for households or individuals. And for most countries, you will be able to find at least one study who has been following this kind of approach. And these consumption-based footprints, they have a lot of advantages. It's very intuitive usually for people to understand. If you tell them part of your footprint is what are the emissions that were necessary to produce the goods and services that you consume. So if you buy a laptop, everything that was necessary to produce that item is included into your footprint. And the consumption approach also addresses this issue of outsourced emissions. So it doesn't matter where these emissions actually took place. If the laptop, for example, was produced in another country, would still be included in the footprint of the person who purchases it in the end, and also in the footprint of the country where this person is located, if you look at footprints on the country level. And it also means that there's for consumption-based footprints, there's also no double counting, because all of the emissions will in the end be reallocated to final consumers. So, but at the same time, it also means that this approach is a bit narrow, because it assumes that all of the responsibility and all of the emissions fall on the final consumer. And we know that as a final consumer, what you can consume at a certain point in time is also very much constrained by what is on offer in the country you live in, what the infrastructure is that is installed. If some of the items, like very basic necessities that you have to buy, are produced in a very energy inefficient way, there's very little that you can do as a final consumer if you make the decision to buy it or not. And it's also another limitation is that they're not only consumers in the economy, or people are not only consumers. There's also the other side of those who own the companies, and they also have influence over how goods and services are produced in the country. And finally, if we only look at the emissions linked to final consumption, we also risk that we underestimate the carbon footprint of some individuals, especially at the top of the wealth distribution. So if we only look at their private consumption-related emissions, they might still be very high. In many cases, they are very high, but maybe they are able to reduce them over time, or buy electric cars and so on. And if at the same time they own huge portfolios, and we completely ignore the emissions that are linked to that, that could lead to a bit of a biased picture of the total carbon footprint of that individual. So the starting point of this paper was to say there's a need to complement this perspective that has been around for a long time, and to also see how the distribution looks if we take into account these other elements, these other emissions that are linked to wealth and the assets owned by individuals. So what we do, the purpose of the study is to expand the study of emission inequality from consumption to ownership, take into account in the individual carbon footprint the emissions linked to the firms and asset owns, and look at how this changes the distribution of emissions. And in the paper, we always present our results for 3 different approaches. And I've listed them here on the slide. And if you look at the number 3, it's essentially the approach that has been followed for a long time. So we also include the estimates following that approach. So we always have it as a point of comparison, and also because we don't think that this approach should go away completely, but we want to complement it. So we also have the results for the consumption approach. But then we also present emission inequality for what we call the ownership approach, which is kind of the polar opposite case, where we say all of the emissions that are released in a production process go into the carbon footprint of the owner individuals. And then what you see as number 2 listed here, we constructed a mixed approach where we say emissions linked to investment. So in a way, maintaining and expanding the capital stock, these emissions go into the footprint of owners of firms, and the remaining emissions remain with the final consumers. So when I later show the slide with the results, you will also see these 3 approaches, and I think it's a good way to compare how it changes to expand the perspective. One advantage of this ownership approach that we constructed in the paper is that it's also, in the same way as the consumption approach, comprehensive and exclusive. So that means that we capture all of the emissions, but we don't do any double counting. And that's sometimes a problem that exists with other approaches that are sometimes referred to as portfolio carbon footprinting, and there are different methodologies. But in many cases, if you then add up all of the emissions, it's not aligned with macro totals. If you think about theoretically doing it on a global level, you would end up with a lot higher emissions than actually occurred in the year. So that's an advantage of our approach. And it also highlights this new dimension of inequality and points a bit into the direction of other potential policies that might be more progressive and more acceptable. What is also interesting is this new dimension of inequality. We can also look at it within countries, and that's mostly what we do in this paper. But we could also look at the international dimension, and maybe that's something to come back to in the discussion afterwards. We could look at what is the net emission ownership position of countries, for example, and focus more on kind of the distribution across countries regarding these ownership emissions. Concretely in the paper, we first developed these 3 approaches, and then we implement them for France, Germany, and the US. And basically, it's an effort of combining a lot of data sources. So the key sources are we use a wealth survey or distributional national accounts to capture the composition of wealth across the distribution. And we bring that together with emissions data from air emission accounts by industry, and also other national accounts tables, balance sheets, and so on, to make sure we know which institutional sector owns what type of assets. We also need these multi-regional input-output tables to find a proxy for specifically investment-related emissions. And there are also some other data sources that we need to use to make sure we find a way to proxy and estimate these cross-border ownership-related emissions. So this is, for example, the EU EDGAR and FinFlows dataset that we use for that. Now I wanted to jump right into showing you some of the results. So there will be 3 slides. The first one is kind of the distribution of emissions itself. The second one will be more on the composition of emissions. And the third one will then be to show some kind of tax simulation, a very simple one, based on these new approaches. So on this slide, I show the results for the US, so only for one country. And you see that, as I said before, you have 3 graphs. So the left side is, in a way, what has been done before, following the consumption approach. On the very right-hand side, we have this ownership approach, where all of the production emissions go into the individual footprints of the owners. And in the middle, you have this mixed approach, where investment-related emissions go to owners and the rest to private individuals, to private consumption. And you see here, I show 4 different net wealth groups and the full population, and you always see the average per capita emissions. This is for 2019, expressed in tons. I don't know if someone in the audience is not very familiar with these numbers. I think a good matter of comparison is that, for example, a flight from Paris to New York, a return flight, is estimated to be around 2 tons if it's like in a consumption-based approach. So maybe that makes it a bit easier to interpret these numbers. What we see here is that if we move from the consumption approach to the ownership approach, to the mixed approach to the ownership approach, we essentially double the already very high footprint of the top 10%. So that's I think the key insight from that graph, and we also find something similar in France and Germany. Now, in these 3 graphs, you see essentially the same, but we are focusing on the composition. So it's the same colors as before and the same 3 approaches, again for the US, again in 2019. And in green, you see the consumption-related emissions. Red and blue are more the direct household emissions that also in the ownership approach, we do not link to owners because we keep them at the final household. If you burn fuel in your heating in your house, these emissions will stay with you and they will not, because there's no way to allocate them to any other owner. So what we see here is that, and I mean, on the very right-hand side in the ownership approach, the orange, the yellow, and the purple color are these are the emissions that are linked to owning assets. What we see is that for the very top, starting around the top 10%, it's really these ownership related emissions that are dominant and not those emissions that are here in red and blue that are linked to direct household emissions, burning fuels in a car, in a chat, in the heating in the home, and so on. They are also very high, but then as a share of total emissions at the very top is really the ownership emissions that are dominant. Finally, here, this is a graph to show a bit what this could mean for environmental policy. So this is a very basic calculation. And note that here we are not showing in the 3 graphs the 3 approaches, but now the 3 countries. So you have the US on the left side, France in the middle, and Germany on the right. And we show 3 wealth groups, the middle 40%, the top 10%, top 1%, and hypothetically apply a 150 euros or ton tax per ton on different types of emissions. So in green, you see what happens if we apply this tax on consumption-related emissions. So a consumption carbon tax in a way. And on the y-axis, you then see the equivalent net wealth tax this would constitute for this net wealth group. And we see that, I mean, this is not very surprising, such a tax would be regressive, where the equivalent net wealth tax is higher for the middle 40% here. It would be 1.2% than for the very top. And we find something similar also for the purple dots, which represent the direct household emissions. As I said before, heating your home, driving your car, here it's also regressive. On the other side, if we look at the blue dots, which are the ownership-related emissions, and we apply this tax on these emissions, we see an increasing curve, meaning that it's the equivalent net wealth tax would be progressive. And this is an interesting finding, I think, because it's linked to the fact that we find not only that wealth-related emissions and ownership-related emissions increase because wealth increases at the top, but also the intensity increases. So per dollar or euro owned at the top, the emissions in the ownership approach are higher. And that means that if you then apply a tax, like in this very simple static setting, there's no behavioral responses or anything. So it's just to make like a simple calculation, and you see that it has a progressive impact with respect to net wealth. I think these are.
Sorry to interrupt you. You have to wrap up soon, okay?
Yes, I'm almost done. I mean, I can also wrap up here. Just to say maybe that areas that we want to explore in the future is to also look more at this international dimension, where in the paper we just have been looking mostly at the 3 countries and the within country distribution. And then also in another project at what are the responses that we could expect if we really levy a tax on emissions that are linked to owning assets, and how does this translate into reallocating asset reallocation and then into real changes in emissions in the end. I think I will wrap up here, and I'm looking forward to the discussion.
Thank you so much. That was great. And this is really thought-provoking, especially after the panel yesterday on taxing extreme wealth and the potential of tax justice policies, so thinking things like BO and financial transparency more generally. And I'm sure we'll cover this in the discussion. Now, speaking of financial transparency, Matti, you're the last one. Should we go up?
Yeah. So yeah, I think this paper, you can hear me fine, is a more of a review of how we can meet that climate financing gap, the international climate financing gap that Franziska mentioned earlier. And it does in many ways neatly actually correspond to some of the gaps in tax evasion by corporates and potentials of wealth taxation. This is something you probably know, but it's just to recap that there's a gap in terms of adaptation mitigation financing that is estimated between 140, 300, then loss and damage will be much more, and rising, of course, and this could rise into trillions very soon. Now, how do we make the linkages between tax agendas and the climate change agendas? I'd say that there are 3 ways to make those linkages, and all of those 3 pathways need to be observed. But currently, there's only one pathway that much of the climate movement is actually looking at, which is linked to the Bridgetown Initiative, or indeed the Paris Summit for the new financial pact last year, which looked at the potential for solidarity taxes that were actually quite small in scope and quite low in their estimated revenue potential, and therefore relying largely on private financing, on loans, on PPPs, on instruments that create more debt for the global south. And that has a harmful impact in that debts have to be paid back. And even though they're concessional, they don't, the quality of climate financing is not there. So we should be really looking at how the international tax system, the cross-border tax system, creates more financing that is allocating taxing rights to the global south, which is then Paris compliant, looking at the historic emissions, and also looking at how tackling illicit financial flows extracted from the global south is, I would believe, by far the largest resource outflow that global south countries suffer. Then there's a déjà vu. We've been here before. Because in development financing, we were looking at some of the gaps and some of the initiatives, and at the time in 2004, those who remember Landau report on innovative sources of development financing were looking at financial transaction taxes, were looking at portfolio investment taxes, wealth taxes, carbon emissions taxes. Interestingly also, tax on multinational profits. Look at that little line there. This was 2004, 25% on profits of the 1,000 largest corporations basis 2000. This is a recap in the history of the tax movement, but this was already thought of. Now, what they did after that was to look at the potential of the financial transaction tax in Europe, airline ticket levies and such. And actually what did happen in development financing terms is that only the air passenger levy, France has one, generates about 200 million a year. I think a bit more because there's now a domestic supplement to disencourage especially domestic flights. But that's reallocating that revenue for passenger trains, I think, in France. So not necessarily international development or climate finance, but its purpose for other purposes. Maritime shipping taxes, bunker fuel taxes are discussed heavily by the climate movement. And of course, that could be welcome, but the method is the International Maritime Organization, and it was blocked there. And I think the next time it's available for discussion is in a few years' time. And the revenue potential could be interesting if the carbon emissions were put at the right level of per ton emissions, but it's not very much favored by some of the key exporting countries in the global south. So they might not actually gain support. Financial transaction taxes would be progressive. More rich people do share transactions, especially more you go into derivatives, including also currencies. But we tried that in the European financial transaction tax from around 2005-06 onwards to about the peak was around 2010, and it didn't go through in the enhanced cooperation in the EU with a revenue potential about 50 billion. And it could be, of course, if you add derivatives and even currencies, it goes well into more than 100 billion in annual potential revenues of a financial transaction tax. But it requires a large group of countries to do that so that the transactions don't shift to another country, especially derivatives. Now, we've had this discussion in the development finance sector. It's almost like the climate finance people having the exact same discussion. And the revenue and the likelihood of some of those more collecting taxes are fairly low. So so therefore, why don't we look at how the international tax architecture could be more Paris aligned if it is indeed the case that some of these solidarity levies are not providing the revenue needed to gap for the climate financing gap. As mentioned, state of tax justice, look at, you can split the corporate side. It was around 300 billion corporate tax gap, and uncollected wealth taxes, take your pick, 160, 169, even on quite low wealth tax rates could be levied, or gaps in current even taxation. But some of the better taxes that could even collect more, so new taxes could be done. So not just dodging of existing taxes, but of course minimum taxes. We've talked yesterday about windfall taxes, surtaxes on profits. It would be to look at how the wealthy people and how a wealth tax, a net wealth tax, is a polluter pay tax. I mean, based on also the previous paper very much of how wealthy people not only consume more, but because of their financial investments, they are the carbon elite. They own shares, they own interests in companies that pollute the most. Therefore, a net wealth tax or other taxes on wealth, capital gains taxes, taxes on inheritance and etc. are ways of doing climate finance, or are ways of aligning the tax system with climate principles. However, when we do international tax from a climate perspective, you should be looking at some of the principles in the climate movement. So common but differentiated responsibilities. So when carbon taxes are done cross-border, the current European carbon border adjustment mechanism, which should be really a tax, but it's called a mechanism, is violating that, because it's putting a price on carbon on exports of certain goods, industrial goods, from the global south without consulting them, without considering their historic emissions and their responsibility on the pathway to decarbonization and a pathway to 1.5 degrees. And it put a much heavier price than would be their historic responsibilities. And the injustice is that the North keep the revenue. So not only are we taxing those who are not to be taxed at this stage of the transition, but we're also keeping the revenues in the North to protect the industrial bases from other competitors. So it's sort of, if you like, it's a double injustice there. Now, the revenue potential in lining the wider tax system with Paris, with climate action, is far greater than some of the solidarity taxes, especially if you look at where they are likely to be implemented and what levels. So this is, recapping from yesterday. So this is nothing new, but I would just add, there's also a proposal for a climate damages tax. So taking the kind of polluter pay principle to the most heavily emitting companies, either take a per ton tax as being proposed by Stamp Out Poverty last few COPs, or you could be taking a extra higher global minimum rate tax for some of the most polluting industries. You could differentiate some of the instruments that we use in international taxation for fossil fuel industries and make sure that they pay a higher minimum, or the tax rates are higher. And that way you can think of an alignment with some of the Paris principles and some of the other climate change policies that really are also part of the international agreements. So many of these should be done, and they should be part of what's discussed internationally at the UN tax convention that's now been drafted. So everyone, you still have time to submit until about 5 p.m. today. Make sure to get your voice heard. There'll be other opportunities during this year, but this year is key to make sure that some of the terms of reference and later on the protocols reflect climate action, and that these systemic principles are part of the design of the future tax convention. The third area is that illicit financial flows there are illicit financial flows that are not just tax abuse. So we have resource outflows, so net resource outflows of illicit deforestation, illicit outflows linked to illegal fishing. Illegal, unregulated, unreported is the official IUU term, but illegal fishing for short. Mining of also transition minerals, but minerals in general, create illicit outflows that are unreported outflows of goods and services and commodities. And there are many ways to start to tackle these. And we've explored in FTC fisheries last year, so I can talk about that a little bit, but not too much, but just to say that there, the incidence of how you tackle fisheries-related illicit financial flows is through having an asset registry of vessels. So who are the offending vessels who are extracting fish? Distant water fleets are in the thousands of not just China, but also Spain, US. Many countries have distant water fleets that fish. France that fish in the world's oceans. They're very lightly regulated, especially when you fish in the high seas. Only a few species are regulated. Even less so are they monitored. Now, monitoring could be increased through a better use of automated information systems. So there's a tracker on every vessel. If they do patterns of boat movements that look like fishing, they should be criminalized if they do those in the wrong places and in the wrong time without licenses. Currently, an odd pattern that looks like fishing can't be called illegal fishing. So we should be harsher on using the data to spot behavior. And we should be looking at then linking the crime reporting on illegal fishing to vessels. And then once you know the vessel, you can find through insurance data the company. So insurance is mandatory for any large vessels. It'll be on the Lloyd's database. That's a private database for insurance. And from that, you get the company. But then the one that piece that lacks, only for 16% of vessels implied on illegal fishing did we ever find one single beneficial owner of the boat. 16% we could find a single beneficial owner. And it was not even really a beneficial owner, it was a shareholder, could be a nominee. So we had to call it an individual shareholder nominated, however you do the mental gymnastics of when it's not quite sure that it's a beneficial owner, but it's a shareholder. Same thing for logging. There's a lot of satellite data today to see where exactly deforestation is happening. And of course, it's happening in places that were mentioned earlier, but we could be utilizing satellite systems. Then we need land registries. So again, another asset registry linked with company and beneficial ownership registries. These go into hundreds of billions if you add just three sectors, including wildlife, on how much IFFs are done. And I didn't even include mining. So just to say, you can find who's behind illegal fishing. There's the top 10 list. It's in the slides, you can check it later. And the top one was sanctioned by US Treasury under the Magnitsky Human Rights International Act. So, they are also money launderers and they could be taken out. And I'll just leave this as a reference, but AML laws need to be updated to include these illicit outflows. So those are the three areas. They all need to explode. Corporate tax and IFFs, to me, have the greatest revenue potentials in collecting revenues that are aligned with Paris, and indeed also once looked into further to potentially also become accounted as international climate finance flows to meet the famous 100 billion, which I always say is peanuts. It's too small. There we go. Thanks.
That was record speed. That was great. Okay, now, perfect. Now we have exactly a little bit over 15 minutes for Q&A. Sorry about that. So we have time for some closing remarks. So if you have a question, please raise your arm. Please say where you're from. Please try to keep the question concise because of time. And we'll collate a few. And tell us who you're asking the question, please. So Jayati, and then maybe over here as well.
There's somebody in front as well.
Yes. Emilia and Jayati first, and then we'll go over to the side afterwards.
Thank you so much. Thank you for this panel. I just wanted to warn the room that there is a larger framework, which is the planetary boundaries, and climate change is just one of the 9 planetary boundaries, and we have gone above 6 of them. Or there are other scientific reports that says we have gone above 7, and so just focusing on climate emergency without seeing the bigger pictures is a great risk, especially because the climate movement, moreover in the global north, is extremely regressive, because what they're imposing is under the narrative of the green New Deals, etc. What they're promoting is actually a new door for neoliberal projects, and especially what we call false solutions or dangerous distractions, such as nature-based solutions, geoengineering, etc., that are opening the door even more for IFIs to dig in and creep into the territory of developing countries to bring a new mega project wave that is going to be devastating for the ecosystem integrity overall. So just wanted to caution this notion. And then therefore this narrative of tax justice, where is the justice in the discussions that you're having? If you are are focusing more on tax and the monetary aspect, where is the notion of the system change that you're trying to promote? And at the same time, where is the notion, the principle? I think I very much welcome those who brought in the principles of common and differentiated responsibilities, the fair shares, and the colonization of the atmosphere, etc. But this is happening in every realm, and we are living literally in an imperial and colonial many dimensions. So tackling the global north responsibility on all of those dimensions is key for us in the global south, especially when we're talking about the ecological challenges. So to avoid being on the regressive narrative on the climate emergency, there is a bigger dimension that needs to be asked in this session. In how are we engaging with other movements? How are we listening to indigenous peoples and the demands of other movements, while we are questioning really at the structure, imperial and colonial dynamics? And just a warning that even UNCTAD in the LDC +5 last year, they were telling LDCs that the wait for them to graduate was to deliver the rare minerals for the global north countries, and that will be the new way into coming into the development framework. So these are very dire questions, because we will be devastating the ecosystem integrity, and the world will come to an end for that, and we have having us reduce the carbon emissions. So these are very important questions, and the tax movement cannot remain on the tax dimension. It has to fall into the justice discussion. Thank you.
Yeah, thank you. I think this was a terrific session. I really want to congratulate all of you. The excellent presentations. And I'm really happy you have moved away from this focus on carbon taxes, which I personally have always found extremely regressive and really anti-people in that sense. But I'm thinking now in terms of, I agree with everything you said, wealth tax, etc. All of those things would have much greater impact, certainly in terms of collection. But in terms of dealing with climate, a wealth tax is not really going to change that much. It will generate revenues, but it will not change that much, because the market incentives still remain heavily skewed towards financial investment in brown stuff, fossil fuels, etc. So I'm wondering whether we can think a little more imaginatively of specific sectoral taxes on the fossil fuel industry. Financing for fossil fuels is subject to a different rate of taxation than financing for others. Profits of fossil fuel sectors are subject to different rates of taxation. Why don't we just go that direction? Look at the producers, look at the capitalists, look at the ones causing the problem, rather than focus on consumption. Yeah.
Great. Did you want someone to answer specifically, or was just more of a comment? Yeah, maybe Matti, you want to start? And if anyone else has comments as well, you can, that should work, yeah.
Yeah, I think on the differentiated taxes on fossil fuel emitters, I mean, absolutely. I would think that that's the next sort of way to look at this debate, is to have maybe a higher minimum tax, which could be advocated for fossil fuel industries. I think fossil fuel industries is well defined. We know what those few thousand companies are. And we should be really looking at a higher rates of surtaxes or windfall taxes whenever those are applicable and necessary. And I think that's what we should look at. I should say that a wealth tax, because of them being the carbon elite, can be a progressive carbon tax as well, but it does maybe rely a lot on the usage of the revenue to make sure that it actually goes into climate action. I would say the second way, I think we should remember the illicit financial flows approach. Gradually, we should make so natural resource crimes are already money laundering and illicit financial flows, and that means that they're completely illegal. I think we should look at, when do we call carbon, coal, especially as the most heavily polluting industry, money laundering? And when do we criminalize extraction of coal and usage of coal? So where do we start to look at? So illegal fishing and deforestation, those are already considered natural resource crimes. And already we say that, there's now supply chain directives in the EU to say crops grown on or commodities grown on recently deforested land will no longer be accepted in EU supply chain. So it's not money laundering, but it's a supply chain infringement. The trouble with that is that it takes smallholder crops in that directive. So coffee and cocoa in many places are smallholder crops, so you're penalizing the wrong people. You should be only really penalizing large, plantation crops. But we should be looking at those differentiated ways, absolutely.
Laure?
I agree with Matti, but I think for Jayat, it's a very interesting question, but it's a tricky question. We need to transition from fossil fuel, right? And we need green technologies, okay? But you need to extract that. So you need cobalt, lithium, right? But to extract that, if you put a tax, it's gonna also for tax on mining companies, for instance. This will this can slow down the transition process. So that's why it's a tricky question in a way that there is a need to put tax, but by putting a tax, as we need green technologies, the extraction of minerals could be more expensive. So, and why it could be more expensive? Because in Global South, there is not yet net zero industry. They do have, I'm thinking about the DR Congo, Inga. There is a possibility that Inga become a green infrastructure. But again, there is a need to finance it.
Okay. We have some more questions over there. Can you take two, maybe? And then we check the time.
Hi, thank you so much. My name is Gina Cortez Valderrama. I am here on behalf of the Feminist Action Nexus for Economic Justice, but as well as co-facilitator of the Women and Gender Constituency, part of the Convention for Climate Change. I am very concerned on the framing that I have heard during the panel, in the sense of how there are being calls for incentivizing different dangerous distractions, also what we call in the climate space as false solutions, when we talk about carbon markets, carbon pricing, and how this is actually, instead of supporting and pushing for financing different climate solutions, is rather being detrimental. Carbon market, so to say, is by no means a shift of that systemic transformations that we want to see, but instead it is a way of perpetuating exactly that exploitation of our bodies and our lands and our territories, cause forced displacement, particularly of Black, Indigenous, and people of color. So it is also important, I think, to mark on how these market approaches envisioned in Article 6 in the Paris Agreement are not really responding to the purpose and to the aim of the Paris Agreement, but how they are taking us backwards. And I as well appreciate the comment and the call for guaranteeing and to demand and advocate for the principle of common differentiated responsibilities, because I feel that in the conversation we are totally lacking this understanding and this colonial anti-racist analysis that brings back the historical responsibilities, the ecological debt that countries have in the different territories and in the global south, and how we need to start be looking at to that more wider macro picture of how these systems of oppression have been operating and how the reductions need to be done on the source and on the different systems. And by this, I also mean how the answers to the climate action is not by commodifying and keep commodifying nature, but really how we need to respond on that. And I do as well join the call that Emilia has been doing, because I think that for the tax movement, would be very, very helpful to have a conversation with the climate movement. There have been comrades in the climate space that have been pushing back for decades Article 6. They have been stopping and staying until very late at night, blocking any negotiation, peace and discussion, saying that we prefer no decision, we prefer no agreement, that a bad decision that is going to foster this type of market-based mechanism that the World Bank and many others are there. So in a way that we as movements are not detrimental to each other, let's have that conversation, let's open the scope, and let's strengthen our vision of justice when we are talking about tax justice and not only about money. Thank you.
Thank you. I want to echo the worries that I'm hearing here, and I want to bring it to something very practical. So I'm from Brazil, and one of the worries we have in Brazil, the first one is over 60% of our emissions is because of land use. So it is deforestation. And I heard Matt mentioning and Laure mentioning deforestation and mentioning the fact that you gave a solution, for example, so things that have been planted on the forest land could not be part of global value chains anymore, for example. I don't see that happening without other changes. I think Brazil is one of the biggest food producers of the world. It's not that simple. And I don't know how any of the solutions you're bringing here about would change this logic, this very market-oriented logic of leading to deforestation. This is one thing. The other, for example, when I'm working on this in Brazil as well, and we're talking about the energy transition, and we've been pushed kind of very European-oriented new forms of development. And for example, we look into the Northeast area, where we have a lot of land now being used to create solar panels and things like that. That also leads to deforestation. That is leading to very precarious jobs in the region, and we don't even know how to measure that. So we don't actually have a framework to look into this as how we are dealing with the two dimensions, the social and the energy transition dimension at the same time. And I wonder, so the question for the panel is, one, how is all the things that you're doing taking into account the problem of deforestation seriously? And second, are you taking the social dimensions of those solutions also into account? And are you taking it into account on the value chain, all of the chain of things that are changing when you're doing your work? Thank you so much.
Okay, one more question, and then we're going to have to pass on to closing remarks. Martin?
Okay, thank you. I'm Martin from Oxfam, and maybe the question goes mostly to Yannic, but anyone, and it's how to go from the top 1% wealthies as a statistical group into taxable individuals. In other words, if it's possible to have a wealth tax that is both differentiated on how much pollution the assets, how polluting they are, and how rich you are as the owner of them, and how could that be designed? Thank you.
Great. Can we do a very quick answer from you on the first comment, if you want? Yeah, on deforestation, and a very quick answer from Yannic on Martin's question.
On the deforestation question, yeah, it doesn't take into account how Brazil is a huge beef and soy exporter. And if you take out commodities produced on recently deforested land, is defined as post-2019 deforested land. So there's plenty, of course, of pre-19 land. But it doesn't take into account that beef consumption is growing. We need to address these ecological boundaries of expanding consumption of heavily resource-dependent food items, and that really is part of these planetary boundaries that we've already exceeded. So there needs to be a much bigger thing, and not just banning, but because also it's banning without compensating. So there's another sort of violation in that directive of the historic responsibilities. And who's the continent who are consuming food beyond the ecological boundaries? Well, I'm sure Europe is one of them. So so there needs to be a much bigger alignment of those directives with climate principles and historic responsibilities. But I think it does provide an interesting way of looking at global value chains as a solution to stopping deforestation and its drivers. So there's an intent that's maybe sound. And I think the data needed for implementing that is absolutely not there. So that's something we are looking at. So land ownership, public registries are super important, as is company and beneficial ownership registries, to be able to know who's behind this stuff. But that's, of course, on just the approach of how to implement a directive that has many deficiencies down the line.
Yeah. Yannic, I don't know. Yes, you're up there. Go.
A question. So in the paper, we don't make any concrete proposal for a type of tax that could be implemented, but one model could be to start from a standard tax on wealth and then introduce like a component that depends on the carbon intensity of the assets owned. So this could go in both directions, where you say, if you can prove that the assets you own are very low in carbon intensity, it would reduce your wealth tax payment, or in the other direction, where if there's a high carbon content of the assets you own, you have to pay higher wealth tax. So I think these are the two. This is the most straightforward way to think about a wealth tax that then also introduces this carbon component and also incentives that we could then try to find empirically what they will lead to if people respond to them and reallocate their where they invest in and so on. But I think that could be one basic idea.
Okay, sorry you don't have more time for questions. I'm going to try and bring some order into the discussion, my attempts. Let's see what we get to, and maybe still 1 minute from the break. So there's a lot to wrap our heads around and a lot of great ideas. I think it can help to try and kind of broadly classify everything that has been mentioned today into two slightly different approaches. Point being that there are a lot of options and it's a question of how to go about prioritizing them. The first category I would say is where, at least in theory, options, tax options, fiscal options can be implemented within current tax and fiscal systems and frameworks, even if that might start, as Gabrielle and some others have also mentioned, in more unilateral moves, or say a coalition of willing countries or small coalitions of leaders. And here we're obviously thinking of Brazil and the G20, for example. That would mean a move to more progressive overall taxation, including things like taxing wealth and emissions-intense capital, as was discussed today, and taxing income from work less, taxing the ills in the economy, so carbon pricing, probably not avoidable on the whole, whilst not neglecting well-being standards in vulnerable groups and planetary boundaries, generally higher taxes on corporations, Jayati's point, fossil fuel corporations specifically, polluting corporations and sectors, permanent excess profits taxes rather than one-off windfall, and so on. And I think within the category, it is worth flagging that most people, including policymakers, especially policymakers, see a competition between climate change policies and social justice, a competition that can result in divisions, even among progressive circles. But taxation can effectively contribute to reducing poverty and inequalities, and therefore climate change policy can be a lead up to social justice. So I think that's kind of broadly the first category. It's not perfect, but just to make the point, it starts on an uneven footing, though. It results in a situation where, I think this was Laure's point as well, some countries say in sub-Saharan Africa say, well, we're relying on carbon markets and we're relying on these natural resources because we're lacking revenue and we're not on the table. We're not at the table, sorry, if anything, on the table. And there's missing revenue. So we need to give countries around the world a seat at the table to agree on the role of tax in the first place to mitigate the effects of the climate crisis. So adopting global tax rules that both eliminate tax abuse and redistribute revenue. And I think it is our job to draw attention to the fact that the way the international tax governance system, all of the points that Matti, for example, mentioned, has been set up is to deprive countries of the tax revenue they're entitled to. And I think within the tax justice movement, that argument kind of has been made up to a point pretty well. Now, I think there's a second layer to the argument, which is to say, together right now, this revenue, if anything, is lacking more than ever. There's more urgency and a cause for it than ever before. And that's in the context of the transition and the financing. So that leads us to all the multilateral changes that Gabrielle has brought up, unitary taxation, corporate income with a global minimum tax rate, but also things like BO, financial transparency in general, automatic exchange of information, and so on and so forth, for which we see obviously the role at the UN more than the OECD. So I have 1 minute to do a quick plug. I do think that at Tax Justice Network, we do see a role for climate reparations. It is an evolving discussion and obviously a fairly sort of radical concept in some circles. But we think that even though it might not become a reality, it is worth discussing it to move the needle of the discussion, just to reflect the scale of the injustice and the historic injustice that has been committed. So there's some interesting research that has been done on Hickel, Fanning and others on atmospheric overshoots of specific countries and compensation schedules from global north countries to the global south. We think there might be a role to continue this kind of research, perhaps more at the individual level, perhaps looking at corporations as well. So if anyone is keen on that, please approach us in the break. And otherwise, thank you very much for the great questions and the great discussions, and most of all to the speakers today. Thank you.